This video is going to go over flag patterns. Flag patterns basically occur after a major momentum move. In other words, the market might shoot up and then it kind of goes sideways. And you basically are looking for a breakout in the direction of the trend, which is up in this case. And when price breaks out again, you go long. The second it breaks out and your stop's right underneath the sideways consolidation. The number of pips that is away determines the position size you have. Watch our position sizing video. Sometimes it's 5 or 10 pips, which allow you to trade double a 20 pip stop. 10 pip stop allows you to trade twice as many lots as a 20 pip stop. And that's where you get in, and typically you want to draw your fib on that first swing and either exit the trade at the 1.38 or 1.618 fib target. For downtrends, it's the exact opposite. You have a big trend down, or it can be a gradual move down, and then the market kind of chops around in a sideways action. Sometimes it does this, and basically you're looking to go short when the price breaks the low. Sometimes these find reversal patterns, but that's not nearly as predictive in terms of looking for a counter trend trade, trying to buy the bottom or sell the high, as it is a continuation pattern. So to repeat, this is more of a continuation pattern than a counter trend pattern. Let's look at some examples. This is a wonderful example because we have two different flag patterns on here. The dollar Swiss shoots up and it goes sideways here for about 15 to 30 minutes. And when price goes over the high, you get in. And like I said before, frequently you can draw your fibs on here and look to get out somewhere near the first or second fib target. In this instance, after the market shoots up again, it creates another little flag pattern. Sometimes they have flat tops and sometimes they have kind of wedge-shaped tops. And when it breaks out here, you go long again. You put your stop underneath the consolidation low, and again you draw your fibs on here, and most of the time somewhere between the first and second fib profit target, the market's going to run out of steam. Here you have what looks to be a flag pattern that doesn't work. You can see the market shoots up, got a flag pattern right here, and instead of breaking out to the upside, it breaks down. Now, like I said before, sometimes this can be used to find the counter trend move, but anytime you have an explosive trend, it's more likely to go up after a pullback. And so when the market comes back and goes sideways again right here, you might consider this kind of like a wedge-shaped pattern breakout. You're long here, or this is a perfect example of a flag pattern right here. Goes sideways for 15 to 30 minutes or more, and then it goes up. Here's a good example of it on the downside. The market goes down. We have a little flag pattern right here where there's no pullback whatsoever. There's not enough buying to even cause it to retrace to the 38% Fibonacci pullback area, and you go short when it breaks down, and you draw your fib levels on here, and you can see the second fib level pretty much nailed the majority of the move. You can also add our tools to your chart to improve your odds. We'll add the IntelliTrend, which colors the candles 11 different shades of red and green. And we'll add the FX Trend Intensity Pro, which shows real-time momentum. Anytime the up or down trend hits this dotted white line, the 20 level, the trends usually continue. Let's go back and look at the dollar Swiss again. Notice this flag pattern right here near the high was accompanied by off the charts statistical strength. That increases the odds of one of these flag patterns breakouts continuing in that direction. So this one was a phenomenal trade, and again the market went up and stalled out at the fib target level up here, went up another 50 pips. Anytime you have the previous swing with off the charts momentum, it's usually after a flag pattern likely to continue. Or if this first flag pattern here had more strength than the market had all day, or more strength than the weakness peaks. If the previous weakness was here or here, and those were the peaks, you know, this one right here had more weakness than that first flag pattern or equivalent. But if this was close to the 20 level, it also increases your odds. Now here's a downtrend, which basically goes sideways for quite a while. I wouldn't call this a flag pattern because usually flag patterns are not that long. This is more of a wedge shape breakdown based on our other method. Now remember, follow our exit methods. Once the market moves 5 or 6 pips your way, you cut your stop in half. Once it goes 10 pips or more in most of these currencies, you move your stop to break even. You can consider this a flag pattern that failed. The market shot down, it had incredible weakness. You draw your levels on here when the market broke down underneath that flag. You go short, and notice you're short around 77.10, and it went down to 02, so it went more than 5 pips. You cut your stop in half, and this is why we do this for the instances where trades don't work, and when the market comes back up, you lost 5 or 6 pips. This one I wouldn't consider a flag because it went sideways a little bit too long, but basically whenever the market makes a double bottom and fails to get a bounce off of it, that's a whole different system in getting into that trade. I'm going to scroll back to find examples in previous days. You can see the New Zealand dollar starts coming down here, and you got a little flag pattern right here, and it breaks out to the downside in the direction of the trend and continues down for another 50 or 60 pips. Here's a good one on the euro yen. It shoots up, goes sideways for not much more than an hour, little flag pattern with higher lows, and it breaks out, and on top of that you had off the charts incredible strength, which means the euro at that time was one of the strongest of all the pairs, and the yen was one of the weakest, which means it's very likely to continue up. So when you use these patterns in conjunction with our real-time statistical trend tools, we compare every currency to every other one on multiple time frames using multiple statistical tools, average those together, and that's how we look for what we consider to be higher probability trades.